Hey everybody, let's do a rundown of the Phoenix real estate market. So I just updated the data with the latest data, and it looks like it's going to be a totally wild year next year. This is the number of homes for sale, and it's running half of what it was 2 years ago. This is what it was at the beginning of this, or beginning of last year. So it's a little bit better than the beginning of last year, but it's still incredibly low. We're going to get a wild, wild year, at least for the first 6 months. My prediction is we're going to get, or my forecast, well, we're going to get a wild 6 months, and then that'll be the top for this cycle. So what's causing it? Well, here's the number of homes hitting the market. It was up for a while, came down, and it was strong. You would think, hey, look, prices are so high, there's a lot more homes hitting the market. That's what you would expect would happen, but that's was counteracted by the number of homes under contract. The sales were also really high. So that was the unexpected thing for me anyway, was that we had so many investors come in the fall, a huge number, and that was not letting the number of homes for sale increase, keeping the market really tight and setting up 2022 to be a crazy year again. So what's driving the market right now? Well, it isn't interest rates. Interest rates fell for 2 years, but it's been a year since they bottomed out. The thing that came in, and then we had the COVID, so we had a low supply. Like in Arizona, January was the peak COVID deaths, so people weren't putting their homes on the market. First, we had 2 years of falling interest rates. Then nobody's putting their homes on the market because they're so scared, of course, obviously, because of COVID deaths. And so the market just went insane last January, February, over the first 6 months of the year or so, and then it leveled off a little bit. And then we got the third phase, which was the investors coming in. And here you can see this is by the second quarter and third quarter, the number of investor purchases were way up. So it looks like maybe in the last few years, it's been about 5,000 investor purchases per quarter. If we go all the way back to the early early 2000s, it was like 2,000 per quarter investor purchases in Metro Phoenix, and this is all types of homes. And that's why we had such a strong market in the fall instead of we having the supply of homes for sale increasing. It didn't because of this. Here's another Redfin chart, and it's looking at inventory. This is Metro Phoenix, all residential inventory. This is at the end of the period, how many homes were for sale. You see at the end of November, there was 9,000 homes for sale. Super low. And that's why we're going to have a crazy 6 months coming up. So then I asked myself, so if we didn't have those huge investor purchases in the second and third quarter, where would we be now? How many homes would we have for sale? So let's look at it. If those investor purchases didn't come in and those homes stayed on the market, where would we be now? Here's what I found. Okay, this is the chart I just showed you. And if we had investor purchases going about 5,000 a quarter instead of the 7,400 a quarter that was what happened for the second and third quarter, we'd be up here, which would be uh, kind of getting towards normal so we would be moving up, and that would change the market. If the market saw that the inventory was increasing, that would change things. They could see the direction was headed. And if we had gone back to the kind of investor purchase we had 20 years ago, we'd be back here. We'd be at levels we had like in 2015. It would be completely over by now. So why did we get the investor purchases skyrocketing so high? I'm not an expert on this, but some of the things people talk about is bond yields were so low, meaning that the interest rates were so low. People like, hey, I used to buy all these bonds. What am I going to do with them? They're terrible. I'm not making any money. Hey, what's something else safe? Let's do real estate. Another possibility is inflation, and the timing would fit this. Is people think, oh, inflation is starting to take off. What's a really good hedge against inflation? Oh, real estate. Let's do that. And I'm not a Wall Street person, but Ivy Zellman, who I really respect, was saying that we kept talking about Resi. I guess Resi is the code or the nickname for residential real estate. That Resi was the prettiest girl at the dance in Wall Street or among institutional investors, meaning it was just the it girl. It was the now thing. It was the thing. So people were going into residential real estate investment. Another thing that happened for the smaller investors is there's a uh, a philosophy called BRRRR. It says buy it, rehab it, rent it out, refinance it, cash out, refinance it, and then repeat, then buy another one. So what that is to say is if you were a investor and all your homes went up $100,000 in 1 year, if you wanted to buy some more investment real estate, you certainly were able. You would just do the cash out refinancing, and actually it would be tax deductible if you put that tax out refi on your old house and put it into a new house. And so they were very much able to increase it if they wanted to. So what happens if, whether it's the smaller investors or the institutional, decide, hey, it's over, it's not such a big deal, we're not going to buy. They start buying instead of at 9,000 a quarter, they're buying back at 5,000 a quarter. What does that do to the market for Joe Homebuyer? Let's say interest rates go up. They say, okay, it's over now. We're not going to be buying as much. We're in. But let's say another thing happens. Interest rates go down, or let's say inflation goes down. So then they think, oh no, this inflation play I was doing seems like it's not working out as well. So I'm not going to be putting more money into it anymore. The net effect is we'd end up with really high prices, but the level of demand is lower. Where before the higher prices increased demand, now the higher prices would be decreasing demand. So my worry is we're going to have a really strong 6 months, but it's going to peak in the summer, and then we'll see a really strong increase in inventory as these motivations for the investors are removed. And then we see, as I showed on that other graph, that the inventory will be increasing quickly, which changes the whole philosophy on whether to buy right now or not. Okay. Basically, investors destabilize the market because all these factors are not having to do with housing so much as other factors having to do with interest rates, et cetera, and the fact that they're not getting a return in other investments, and then but mainly the problem is that investor can jump in and out. They can destabilize things. Investors can jump in and out and destabilize the market for normal people just looking for a place to live and a place to raise their family. Hey, great. I really appreciate your listening. That's super cool. Thank you. Take care.